So I think financials can re-rate in that world. But Ethereum is sort of the network value beneficiary. So I think Ethereum between now and year end, let's say Bitcoin is 2x upside from here. I think Ethereum is more than 2x upside from here. But longer term, in the BitMine presentation, we pulled some work from Mosaics, and let's say it's 5-year view for Ethereum. It comes to around $60,000 per ETH. So a lot of upside in the next 5 years.
In the evolving world of crypto, cycles have long guided traders and investors. As Tom Lee, a renowned market strategist, points out, many still view markets through the lens of Bitcoin's 4-year halving rhythm, where price movements became the main signal in the absence of centralized information. But Lee emphasizes that the old playbook may no longer apply. The harsh crypto winters of the past, when Bitcoin collapsed 70 to 90% from its peak and altcoins fared even worse, aren't what he sees ahead. Instead, he believes today's landscape looks fundamentally different. One clear example Lee highlights are MicroStrategy, which has effectively become a proxy for Bitcoin by channeling its liquidity into the asset. Unlike ETFs, MicroStrategy appeals to institutions seeking alpha and holds more Bitcoin than any ETF except possibly BlackRock. Through its levered Bitcoin strategy, the company has grown its per-share Bitcoin from $1 in 2020 to $227 by July 2025, far outpacing ETF performance. Over the same period, Bitcoin itself rose about 11x, from $11,000 to $118,000, but MicroStrategy stock surged more than 30x, from $13 to nearly $400. Lee stresses that this extraordinary performance wasn't just about Bitcoin's rise, it was amplified by the company's aggressive Treasury strategy, making MicroStrategy one of the most powerful crypto plays in the market. Before we dive into Tom Lee's perspective on Bitcoin and its impact on the global financial system, be sure to like this video, subscribe for more content, and enable notifications so you never miss the latest insights.
Our FX strategist at the time said that Bitcoin could become recognized as a digital currency someday, but the problem is that it's principally used by drug dealers and the dark web. So it was really deemed as a experiment, but only used for nefarious ways. Although people forget that pirates basically innovated gold. So I think it would have been impossible to actually have a view on Bitcoin and a firm like J.P. Morgan allow someone to actually publish the white paper we did publish in 2014. I know we also faced commercial setbacks when we wrote that first white paper on Bitcoin, and Bitcoin was under 1,000, but we said by 2022, so 5 years forward, the range of fair value was 22,000 to 66,000 for Bitcoin. But we said that, if you triangulate it would be roughly 25,000. We had clients actually cancel service on us. So we had some hedge funds famously tell us that they knew that we were so desperate that we lost all of our credibility because now we were talking about internet money as if it was a legitimate asset class. So it actually hurt us, and it probably didn't become a benefit for us as a company because we committed resources to it continuously since then until maybe 2021. Well, I think when people talk about a crypto cycle and it being 4 years, there's probably some reflexivity at work because the original genesis was that, Bitcoin had a halving cycle. And so people were talking about a price cycle that really followed a Bitcoin in the halving. But in crypto, as you know, because there isn't a company, it's decentralized, and there's no centralized source of information, price itself often becomes really important, especially in the early days. So I think that there was a lot to people looking at patterns and then markets trading on those patterns. And the reality is that it's still true in the equity world because I can't tell you how many of our institutional clients still look at seasonality, which is just applying a calendar to what price action could be, either whether it's credit or volatility or equity. So every element of liquid markets today. I think that there is probably some credence because many people are positing that the 4-year cycle may not be in place anymore. Everybody from Bitwise, to David Bailey, so a lot of OGs, and that has to do with the fact that the incremental buyer of Bitcoin is no longer retail, which was really the story from inception up until probably 2024. And so now in the last 2 years, There's now institutional allocations taking place into crypto, and because of that, it's probably countercyclical. Our crypto strategist Sean Farrell still writes about the 4-year cycle, and it probably doesn't matter between now and the end of the year, because in any case that we should be seeing a lot of strength. But I would say that the real test, there's really 2 tests that will come up. Is one, is Bitcoin going to follow a price cycle next year, which would be a downturn? And is Bitcoin going to diverge from the equity markets next year? And I think that there's a chance that both take place, and that's why we'll be talking less about a cycle, because as you know, Bitcoin also historically followed equity markets pretty closely too. Being theoretical, because I'm not necessarily calling for a correction or a crypto winter. The past crypto winters have been really painful. Drawdowns or declines for Bitcoin from the peak of more than 70%, maybe 90%. And the altcoins and non-Bitcoin doing far worse. I would say that it's not just institutions that are coming and buying Bitcoin now. I think that there is sovereign purchases of Bitcoin taking place. And, the U.S. government, while hasn't completely articulated its strategy for building a Bitcoin strategic reserve, but we know the U.S., when oil prices are low, they are a stabilizer for oil, because they are filling that SPR, or Strategic Petroleum Reserve, at low prices. And that always puts a floor for oil. If Bitcoin enters a winter and the U.S. pursues a budget-neutral strategy to acquire Bitcoin, that means they'll be really active buyers of Bitcoin at lower prices. So if you always have a buyer at lower prices, you're kind of bounding your downside. So in other words, MicroStrategy is an example. Like when you buy MicroStrategy, you're basically buying Bitcoin. And that's because they are using all their excess liquidity to buy Bitcoin. Many people will say, Tom, why do we even need to own a MicroStrategy when I can buy an ETF? Okay. The answer is really comes down to 2 simple things. Number one, the institutional equity world, when a fund manager is trying to outperform or find alpha, they're unlikely to be buying a Bitcoin ETF. So their only way to get exposure to Bitcoin is to buy infrastructure companies related to Bitcoin, but the simplest is buying MicroStrategy. And that's why MicroStrategy, in terms of Bitcoin held, is actually bigger than any Bitcoin ETF. I believe, or maybe they're second to BlackRock, but they're basically larger. But the second reason is that a properly run crypto treasury is growing your holdings of the crypto faster than an ETF, because an ETF by nature doesn't grow your ETF holdings, your token holdings. MicroStrategy calls it levered Bitcoin. But I'll give you an example of how their math worked. When they started their crypto treasury in August 2020, MicroStrategy had $1 worth of Bitcoin per share. The stock was $13 at the time. By the time you got to July 2027, so roughly 2025, 5 years later, they had $227 of Bitcoin held per share. So they grew it by, hundreds, multiple. The price of Bitcoin from August 2020 to July, let's say 5 years later, went from 11,000 to 118,000. So it was an 11 times return. MicroStrategy stock went from $13 to almost 400. So it went up by more than 30 times. Only 11 times was explained by the Bitcoin price increase, which means their treasury strategy, which was properly executed, had an implied benefit of a 20x on the stock price. So a really well-run crypto treasury is going to be a really high-performing stock. In fact, Michael Saylor just posted a chart, since 2020, he's outperformed every single stock of the Mag 7. He's even outperformed NVIDIA during that time frame.
Tom Lee expressed strong optimism for both Bitcoin and Ethereum, outlining ambitious price targets and highlighting the structural advantages that set Ethereum apart. He believes Bitcoin could reach $200,000 by year-end and potentially $1 million in the long term. However, he views Ethereum as the bigger opportunity, calling it the biggest macro trade of the next 10 to 15 years, with the potential to outperform Bitcoin in both the short and long term. Research he cited suggests Ethereum could climb to $60,000 per coin within 5 years, underscoring the scale of this upside. What makes Ethereum particularly compelling, according to Lee, is the Treasury model. Unlike ETFs, which face liquidity and redemption constraints that limit staking to around 50%, Ethereum-focused treasuries can stake 100% of their holdings and fully capture the native yield. This allows them not only to hold ETH but also to grow it over time. He emphasized the concept of velocity, or the ability to accumulate more Ethereum per share regardless of market price. A clear example came after BitMine's $250 million PIPE transaction closed on July 8. Within just a few weeks, its ETH per share value jumped from $4 to $23, even though Ethereum's price remained flat. This demonstrates how a well-managed treasury can build intrinsic value far beyond simple price appreciation, making Ethereum an increasingly attractive long-term play. Let's get back to the interview.
I think you're right. I think that so there's some virtues of a crypto treasury, but I'll speak to Ethereum specifically, that make Ethereum treasuries pretty unique. And I think that's why there's so many in the Ethereum ecosystem. Because number one, Ethereum pays a native yield, a staking yield. And you might say, well, if you own an ETF, you can get the same yield. That's not true. The ETFs have liquidity requirements. So if once they're allowed to stake, and they haven't gotten the green light to stake, they can't stake probably more than 50%.
Because of redemptions.
Yeah, because of redemption rates. So they wouldn't be compliant if they staked more than that. So an ETH treasury can stake 100% of the yield. But number two, because Ethereum is a proof of stake chain, power law comes into play. If an Ethereum treasury is large enough, they are a benevolent factor on Ethereum itself. Right. So let's say that BitMine wants to get to 5%. That's where power law kicks in, because that's when that entity can then work in a way that's benevolent to the system, whether it's seeding DeFi or providing liquidity to the system. Or if Wall Street's trying to come onto Ethereum, you can become a staking partner, or do many of the other rails that will come with Ethereum. So in the crypto treasuries operate almost more like digital infrastructure because of the way they interact with the ecosystem. The third is, I don't think that it hasn't happened in Bitcoin yet, but the Ethereum world, if in the crypto winter you're describing, and something trades below NAV, it's going to create incentives to do horizontal acquisitions, acquire other crypto treasuries. Or some of the crypto treasuries might work in the reverse direction and sell their ETH and buy back stock. And the fourth thing, which I would point out, is you're exactly highlighting a key issue, which is that a first principle of any crypto treasury should be having the cleanest possible balance sheet, because you don't want to have your volatility eradicated or debt to strangulate you. And that's why, a BitMine has only been doing straight common equity to raise capital. A common stock is an equity instrument. And so if the price falls, there's no margin call. And so BitMine, when they announced the Treasury strategy on June 30th, there was $1 million from the legacy company, and that was their debt. And today, the only debt on the company is $1 million of debt. The company has no debt, which means that everyone has the same incentive. Like when you have converts and preferreds and debt, you're creating a lot of conflicting incentives on the capital structure. But when everyone's equity, they're all care about what the stock price does. And that's where a properly executed crypto treasury relies on velocity. And what I mean by velocity is how much Ethereum per share you can grow. On July 8th, when the first transaction closed, the $250 million PIPE, there was $4 of Ethereum held per share. And then on July 27th, we did an update, and we'll be updating it again soon. But a month ago, on July 27th, the updated holdings of Ethereum per share was $22.84. Okay, so Ethereum,
it's probably double that now, Mario, or 3 times. That's insane.
So what happened is like
insane.
Ethereum didn't have to go up in price, but your share price intrinsic value went to 23. That was a month ago. So you can see that if there is some sort of crypto winter in the future, like
There's a lot of room.
yeah, like it depends on how much ETH you're stacking per share. You know what I mean? Because like,
Yeah.
see, from the July 27th date, Ethereum was basically flat and you went from $4 to $23 of ETH per share. So even if ETH fell a lot, you were still better off than you were on July 8th. And I think
So it puts you in a,
yeah, you just think about like that forward
yeah.
ETH per share velocity. I'm still really bullish on Bitcoin. I think between now and year end, I think it's still possible to be 200,000 and longer term, $1 million for Bitcoin. Ethereum, I think, has more upside because and that's why we call it the biggest macro trade over the next 10, 15 years because of both Wall Street building on the blockchain and AI as well. So you have like sort of two cohorts actually probably deciding that it's really additive, right? Remember, the financial system is half of the economy. And in the stock market, financials are trading at a lower valuation than tech. So I think financials can re-rate in that world. But Ethereum is sort of the network value beneficiary. So I think Ethereum between now and year end, let's say Bitcoin is 2x upside from here. I think Ethereum is more than 2x upside from here. But longer term, in the BitMine presentation, we pulled some work from Mosaics. And let's say it's 5-year view for Ethereum, it comes to around $60,000 per ETH. So a lot of upside in the next 5 years.
The evolution of crypto reflects its transformation from a fringe concept into a recognized asset class with growing institutional and sovereign participation. Bitcoin has established itself as a store of value, while strategies like MicroStrategies demonstrate how well-managed treasuries can outperform ETFs through amplified returns. Ethereum offers even greater potential with its staking yield, ecosystem influence, and infrastructure-like role, positioning it as a powerful long-term opportunity. Clean balance sheets, treasury velocity, and strategic flexibility add resilience during downturns, making digital asset treasuries more dynamic than passive holdings. With both Bitcoin and Ethereum showing significant upside potential, crypto is poised to become an integral pillar of the global financial system. How might the increasing role of institutional and sovereign investors shape the long-term value and stability of Bitcoin and Ethereum? So stay tuned. If you found this valuable, don't forget to like the video, subscribe to the channel, and hit the bell icon so you never miss an update. Thanks for watching, and let's see together how the next chapter of Bitcoin's story unfolds.